Okay. Uh, First and first, let me introduce myself. My name is Alwan Ayyasyi. I'm from Bachelor of Accounting, Jakarta State University. Now I want to present about the effect of dividend ratio on abnormal returns with earning information as moderating variable. Okay, my first advisor is Dr. Eti Gurindrawati MSI AK, and then my second advisor is Dwi Handarini SPD MAK. Okay, now we're gonna talk about the research background, why I want to do this research. Okay, the research background. The capital market is a place to bring together sellers and buyer of financial instrument in order to make investment. And what is investment? Investment is an activity of placing funds in the present with the hope of obtaining additional profits in the future. And then one of the investment instruments traded in Indonesian Stock Exchange or IDX is stock, which are proof of ownership of a company. By owning a share, an investor has a voting right in the GMS, and then they had right for residual claims and the others. And today, many Indonesian people are starting to invest in the capital market, especially in stock investment instrument. Reported through Indonesian capital market statistics that published by the CASE, the number of single investor identification or SID in February 2022 reached 8.1 million. The number of SIDs has increased significantly compared to 2020, where in that year the number of SID that registered at CASE was only 3.8 million. The increase in the number of investors of Indonesia is inseparable from the high yield factor provided by the capital market investment instrument in Indonesia. Reported via CNBC, President Jokowi stated that Jakarta Composite Index or GCI had increased by 10% in 2021. It's the highest at the Asia. I think that's gonna be all why Indonesian people is more interested to invest in capital market in Jakarta in Indonesian Stock Exchange. Okay, from the slide before, I have talked about index. What is index? Index is an indicator that describes the performance of stock, but individually or cumulatively. So it describes how investors actually behave at a macro level regarding the price mechanism in the capital market. And then stock price movement are influenced by information received by the investor, and which can be viewed from external and internal factors. That's regarding from Agustina 2014. And the external factor are factors that do not have direct relationship to the condition of the company. In other words, external factors are factors that come from outside of the company, such as interest rates, inflation, and foreign exchange rate. And the internal factor is the factor that have a direct relationship with the company, like company's performance and then the profit of the companies. That can be stated in financial reporting. Okay, and then what is financial reporting? Financial reporting is a form of management accountability for the research managed by the company to parties which have an interest in the company, such as shareholder and the government. It's according to Agustina 2012. Investor can use financial report as a source of information that can be used for decision making, such as management performance, and then assessment of the company by performance itself, and then there are a lot of information that conduct in financial statement. One of the information that related to financial statement is company's profit. What is profit? Based on PSAK 46, profit is defined as a net profit or loss for a period before deducting by the tax expense. And many parties, such as manager and investor, use this accounting profit as a performance measure. And then the element of financial statement that has very high information content is a profit. And then when a company have an increase in the profit, it can be a good news for the investor. Like the investor can imagine that the company is gonna have a going concern. And then uh, when the company have some profit decrease, it's gonna be a bad news for the investor, because the investor think that the company is not have a going concern aspect for the long-term investment. Okay, beside profit, there is an addition data related to the financial statement. Shareholders also have an interest in information that allow them to assess the company's ability to pay the dividends. An increase in amount of dividends paid by the companies is also like a good news by the investor, and a decrease in dividend paid is often bad news for the investor. What is dividend? Dividend are profits distributed to investor based on the number of share owned, which can be cash or the company's shares, and the others asset that can be a dividend. When company distribute cash dividend, it will reduce the amount of retained earning that owned by the company. And what is dividend? If we talk about dividend, we should know dividend per share. What is dividend per share? Dividend per share are nominal dividend that distribute to each share owned by the investor, while the company debts contained in the dividend announcement consists of debt, of dividends declaration, cum debt, and then ex dividend. The date of dividend declaration is the official that the dividend announcement made by the issuer regarding form and the amount of the dividend. And what is the cum date? The cum date is the date of the last day of stock trading where the investor still get the right to receive the dividend. And if an investor buys shares before the cum date, the investor is have a right to what is it to receive the dividend, and while the ex-dividend debt is debt on which the right of dividend are no longer attached to the investor when buying shares of the issuer. So when some investor buy the stock in the ex-dividend, he don't have the rights to receive the dividend from the company. Okay, why the investor are interested in dividends? Because according to Hadi 2020, investor are rational parties, so investors tend to take into an account the expected return that will be received in making investment. And expected return is what is expected return? Expected return is the percentage of profit expected by the investor within a certain period of time, and return in accordance with the risk of the stock can be called a normal return. And then if the investment instrument provide a higher or lower return than the normal return, it can be called abnormal return. And a positive abnormal return indicate that the actual return is greater than the return expected by the investor. And then return have a French name risk. Return and risk are two things that cannot be separated. And to calculate a risk, investors need information in making decisions that they face. That's according to Dewey to 2013. If an event contains information, the abnormal return can occur on investment. But if an event doesn't contain information, the abnormal return cannot occur, and it's in line with signal theory and efficient capital market hypothesis. And what is efficient capital market? A capital market called efficient if uh, the information that occur in capital market, and it can be accepted by the investor quickly and uh, reflected at the stock price. And then uh, the stock price, it can be what is it it can be related with signaling theory that we can uh, talk it at the next slide. Okay, and the slide before we have talked about signaling theory. What is signaling theory? Signaling theory is theory that explain how investors receive a signal related to the company's prospect as seen from the decision made by the company's manager. For example, when manager make the decision to offer the share, it can be a signal that the company prospect are not very good because the management want to share the risk to the investor. And if it was it associated with dividends, there are two things can also be a signal for investor to making decision. When dividend increase, the investor will consider it like a good news because when dividend increase, the investor take this as a signal that management has a good prospect for the company's profits. I mean, in the future, and when the companies decrease its dividend, investor will get a negative signal that management view the companies doesn't have any future prospect, and uh, it's hard to make a profit for the company. And then the announcement related to dividend can be one of the determinants of expected return, which is calculated by the investor as reflected in the stock price movement. There are some previous research that search about effect of dividend on abnormal return and effect of earning per share or earning information on abnormal return. Sofian, that doing some research in 2020, said that dividend have a significant effect of abnormal return because of investor have an interest on dividend. So when investor receive the information about dividend, it reflects on the stock price and the market. And Fu and Blazenko, Yahya, Chuang, and Ngok and Rahayu said that same that dividend have an positive effect on abnormal return, but uh, the research conducted by Rahayu and Wardana at 2021 said that dividend doesn't have any effect on abnormal return. So it's the result of the research is negative influence. So dividend doesn't have any effect on abnormal return. As we see, I see some inconsistency of the result of the research, the previous research. So I want to do a re-research on effect of dividend on abnormal return. And then if we talk about earning information, Idawati and Wahyudi said that EPS have a positive effect on abnormal return, but Sutejo Utami that doing research in 2020 said that EPS doesn't have any effect on abnormal return. So because of it, I want to know how earning information can moderate it, the effect on the effect of dividend on abnormal return with EPS. Several previous studies have examined that the effect of dividend policy and earning information of abnormal return. However, there are inconsistencies in the result, where the several studies state that dividend policy and earning information have an effect on abnormal return, but in the other hand, some studies also state that dividend policy and earning information have no effect on abnormal return. Uh, so I want to do some re-research for these things. So I have a question for this research is, does dividend policy have an effect on abnormal returns? And the second is, does earning information moderated the effect of dividend policy on abnormal return? And based on the research question that have been described above, the objective of this study as follows. The first is testing and analyzing the effect of dividend policy on abnormal return, and the second is testing and analyzing the effect of earning information in moderating the effect of dividend policy on abnormal return. So, what is the benefit of this research? Okay, the benefit of this research contain two things. The first thing is theoretical benefits. From the theoretical benefits, we can this research can be a reference and can be used as a reference for the research in the capital market field, especially for those who want to research at the related to the effect of dividend policy on abnormal return with profit information as moderating variable. And the second is uh, there is an evidence of research gaps found in the previous research regarding the effect of dividend policy and earning information on abnormal return. And for the practical benefits, there are two things that can be a practical benefits. Okay, the first is to provide an information to the investor regarding the effect of the dividend policy of abnormal returns, and providing the information to the investor that regarding the effect of earning information at the time of dividend announcement. Okay, and after this, we're going to talk about the literature review. Okay. First and first, we're going to talk about signaling theory. What is signaling theory? Signaling theory is a theory that explains how the owner information, namely the company, gives a signal in the form of information that reflects from the management, what's it, um, management action, and investor will react to the signal given by the management. And final is a decision made by the management where it can affect investor investment decision. This happens because of the difference in information received by the investor and management, where management can more easily get information related to the company and compared to the investor, so that the investor make the decision from the decision that management is making. And the information provided by this management can generate both positive and negative decision for the investor. Uh, Positive reaction occur when the management takes a decision that can be a reference for the investor regarding a good prospects for the company in the future, such as when the management makes the decision to distribute a dividend. The increase in dividend is considered a good news for the investor because investor think that with an increase in dividend distribution, management is considered capable to increase the profit in the following year. And when uh, the dividend is decreased, so investor thinks that the management cannot what is it cannot have a good profit in the following year, so it can reflect the investor decision making. We have talked about efficient market hypothesis before, so I want to explain again about efficient market hypothesis. What is efficient market hypothesis? Okay, efficient market hypothesis, known as EMH, is a concept developed by Eugene Fama at 1970. This concept states that a capital market is efficient when stock price reflect the losses information available in the market, and the information referred to can be in form of financial information such as a financial statement or non-financial information such as macroeconomical things. And the implication of this theory is that when investors receive information uh, such as splits, merger, and dividend distribution, the information will affect at the stock price movement. So market can be said efficient because of the information is received by the investor quickly. However, if the information is not directly reflected in the stock price, then the capital market can be said not to be efficient or inefficient. Okay, the next theory we're going to talk is about bird-in-hand theory. Bird-in-hand theory is a theory that forwarded by Myron Gordon and John Litter, and states that investors prefer profit in the dividend compared to beside capital gain. So, uh, what is it? Investor more like dividend than capital gain. And this theory makes an analogy that having one pigeon in the hand is better than 1,000 pigeon in the air. So this means a distribution of dividend is more preferred by the investor than the capital gain, because return from dividend are something uh, that more giving the investor assurance than the capital gain. So when the company distribute dividend in high amounts, the stock price will also increase regarding by this theory. And the main title of this research is abnormal return. So what is abnormal return? Abnormal return is defined as a change in stock price caused by the factor other than change that are common in the capital markets. So this is a stock price change by uncommon things in capital market. This change causes a difference between actual return and expected return. The difference between this return causes abnormal return or abnormal returns. And abnormal returns can be influenced by an information circulate in market. If an even content information, the abnormal returns can appear on investment. But if an even doesn't contain some information, abnormal returns cannot occur. So information can make an abnormal return in capital market. In this slide, we're gonna talk about dividend policy. What is dividend policy? Dividend policy is a decision related to the company's financial policy made by the manager. Dividend policy will affect the amount of retained earning owned by the companies, and it can be reflected in the GPR. Because the larger of the DPR of the company, the greater of portion of retained earning distributed to the investor from the dividend. So the larger of DPR, and it's going to be the larger of dividend payout. There are several factors that the companies consider in calculating the portion of dividend distribution. According to Hadi 2020, The factors that influence the distribution of dividends uh, are include one is the first is corporate profits. Why the corporate profits be the main factor of the calculation of the dividends. The component of net income generated by the company in the current year is one of the important components considered by the company in making decision of dividend distribution. Because when a company distribute dividend, the company's return earning will have a reduction. And if the company loses money but still decides to pay dividend, the company's return earning will be negative. So the profits is the main things when companies is want to distribute dividend. And the second things is the legal aspect. Okay, in making decision regarding to distribution of dividends, the board of direction must also consider several legal aspects such as contracts and the others. This is include debit claim with the third parties and another agreement that should be what is it should be known when distribute the dividend. And the third thing is company's growth prospect. Okay, the board of directors needs to pay attention to the growth prospect in the future to what is it to distribute the dividend. For this reason, the board of directors must be observant enough to pay attention to the use of return earning as source of internal financing that can be used at company's development fund. So when the board of directors want to have an expansion in the company, they shouldn't distribute the dividend and the cash portion. Okay, the company's liquidity is also a very important things when the companies want to distribute the dividends. If the company's dividend paid a cash dividend, the directors must ensure that the company's cash portion is not distribute the cash position is not disturbed if the companies distribute the dividend. So the directors should make sure that the company's cash portion is gonna be good when paying the dividend. We have talked about dividend policy, and now there are some of important date when some companies distribute the dividend. Okay, the first is announcement date. This date is official that dividends announced by the issuer, and it's contain the form and the amount of dividends that uh, the companies distributed. And the second is uh, come dividend date. This date is debt with the right of dividend is attached to the shareholder that buy the stocks before and at the come dividend date. And the third is going to be ex-date dividend. This date is uh, that which the right of dividend is no longer attached. So investor who bought the share in this debt doesn't have the right to the dividend that distributed. And the fourth is registration date, and there is the date which investor must be registered as a shareholder that receive and that have a right to receive the dividend. And the sixth and the fifth is payment date. This date is when the dividends are paid by the issuer who distribute the dividend to the investor who are registered by the Securities Administration Bureau or CASE uh, that receive the dividends. And then I think that's all about dividend. Next. The next is learning information. Learning information is component of financial statement that generally the main concern of users of financial statement in assessing performance of a company. What is profit? Okay, based on PSAK 46, profit is defined as a net profit or loss for the period before deducting by the tax expense. Many parties, such as managers and investors, use accounting profit as a performance measure. So the element of financial statement that has a very high information is profit. So when a company experience an increase in profit, it can be good news from investor. But but when a company have a profit decrease, it becomes a bad news from the investor. And the next is event study. What is event study? Event study is method developed by Eugene Fama at 1969, and it's a useful technique for studying the effect of an event. And there are two things that must be fulfilled when doing some event studies. It's the first is market must be efficient, and the second is information provided to the investor is unpredictable. So event studies can be used only when the information can be directly reflected in stock market price. I think that's all next. Okay, the next is the conceptual framework of this research. Okay, an efficient capital market is capital market that has information that can be widely accepted by the investor quickly and easily. So the information can be reflected in the stock price. One of the information that can be received by the investor is related to dividends and also information related to profits of the company in every years. And the research have a desire to find out how the influence of information about dividend policy on abnormal returns and how earned information can moderate the effect of the dividend policy on abnormal returns. For the reason, the conceptual framework that can be described in this research is like this. What's it? Like this table. So the dividend policy, I hope it's gonna be uh, effective the abnormal return, and the profit information gonna be what's it more make the profit information can make the effect of dividend policy of abnormal returns can be what's it can be higher. So the profit information can moderate the effect of dividend policy on abnormal return. Okay, the next is the previous research. Okay, we have talked it at the slide before, but we're gonna talk about it again. The Soviet doing some research in 2020 that said dividend have an effect on abnormal return, and also Fu and Blazinsko, Yahya, Chu and Ngok, and they also said that dividend have a significant effect on abnormal return, but Rahayu and Wardana in 2020 said that dividend doesn't have any effect on abnormal return. So I see some inconsistency of the result. So I want to took this research to prove uh, if dividend have any effect or not on abnormal return. And also in EPS, Idawati and Wahyudi said that EPS have a positive effect on abnormal return, but Stejo and Utami said that EPS doesn't have any effect in abnormal return. So I see also inconsistency of the result in this research. So I want to prove that uh, is the EPS have what's it an effect or not in abnormal return. Okay, the next is hypothesis development. The first hypothesis is dividend payout ratio has an influence of abnormal return. First, I want to explain why I choose this first hypothesis. Okay, dividend policy is a decision taken by a company to share a portion of its profit with the investor in the forms of dividend. And dividend policy, especially the amount of dividends described in dividends payout ratio or DPR. So uh, the DPR, I hope in this research can have an impact on abnormal return because when the company distribute dividends in large quantity, it will have a positive impact on a stock price. This is because of investors are looking to get higher returns when the dividends given by the companies are higher value, and but the company provides when the company provides lower dividends, this will have a negative impact on the stock price because investor will tend to get lower returns than the companies distribute to a lower nominal dividend. This is in line with bird in hand theory, where this theory makes an analogy that having a pigeon in hand is better than a thousand pigeons in the air. This means that distribution of dividend is preferred by the investor compared to the capital gain because return in form of dividend as considered as something what is it definitely by be received by the investor than a capital gain. So when the company distribute dividend in high amount, the stock price will also increase. This is what is it? Yeah, in line with bird in hand theory. So In addition, a signal in theory is started that investor can receive a signal of the company when the company giving a dividend, and it reflected but reflected to the stock price. Okay, for example, when manager make the decision to offer the share, it can be a signal that the company prospects are not very good. So the manager want to share its risk to the company. This is because the company is more interested to sharing the company risk with the investor because not seeking for funding, not for funding in through the debt. Uh, if it associated with the dividends, there are two things can also be a signal to the investor when making a decision. When dividend increase, investor will consider as a this is as a good news because of when dividend increase, investor consider that the companies can make a profit for the several years, and there are also several studies that examine the impact of dividend policy with DPR on abnormal returns. Okay, the research conducted by Sofian et al. At 2020 state that DPR has a positive influence on abnormal returns, which are described on the stock price, and this is also was it in line with signaling theory because the dividend distribution can be a signal for investor that the company is able to generate profits for the long term in the future. But some research conducted by Rahayu and Wardana 2020 states that the dividend policy doesn't have any effect on abnormal return. So there is some inconsistencies from the result. It's because of when Sofian said that DPR have a positive effect, but Rahayu said that dividend doesn't have any effect on abnormal return. So that's why I have first hypothesis that said that dividend payout ratio have an influence on abnormal return. So the second hypothesis is earning information moderates the effect of earning information on abnormal returns. I mean, in earning information moderates the dividend policy effects on abnormal return. So I want to tell you why I choose this second hypothesis. Based on PSAK 46, profit is defined as a net profit loss or loss of for a period before deducting the tax expense. Okay, many parties such as manager and investor or use this profit as a performance measure for some company. And the element of financial statement that has a very high information is profit. When a company experiences an increase in profits, it can be good news for the investor, but when a company experience a decrease in profit, it becomes bad news from the investor. It's in line with a signaling theory where when a company provides a positive information such as companies recording positive profits books, the investor have a signal that and will assume that the company will be able to operate for the long term. And there are also several previous studies that discuss the effect of earning information on abnormal return. Research conducted by Maulidina at 2018 states that earning per share has an influence effect on abnormal return, but searched by in addition, research conducted by Agustina and Chianto 2012 states that the net income has also an influence on abnormal return. So, invest in earning information has an influence on abnormal return because of the profits generated by the companies contain useful information for the investor. The higher profit generated by a company, the higher profit that generated by the company, the more investor will be more motivated to invest in the company and in the hope of getting the maximum return for their investment. And the influence of earning information or abnormal return make me as a researcher interested in seeing is earning information can be moderate the effect of dividends policy on abnormal return with EPS as a moderating variable. For the research, for this reason, that's why I choose the second hypothesis that earning information can moderate the effect of uh, dividend policy influence on abnormal return. And next is I want to talk about research method. Uh, Now I want to talk about unit of analysis, population, and sample. Okay, unit analysis and this research is companies listed in the LQ48 index in Indonesian Stock Exchange, and the population of this research is going to be abnormal return in 45 companies listed in the LQ45 index in Indonesian Stock Exchange, and the sample of this research is going to be abnormal returns from 28 companies listed in the LQ45 index in February 2022, with 177 occurrence of dividends distribution in the period of 2015 till 2020. Okay. How did I collected the data? I collected the data from the Indonesian Stock Exchange for the annual report, for knowing the EPS, and I'm using NeoHoltz Mobile, that it's an application from Mirai Asset Securities to know the stock price and the even of dividend even. So I use the NeoHoltz Mobile for searching for the stock price and for the dividend even, and I'm using annual report from EDX for the EPS. In this research, I'm using three variable. The first is dependent variable, the second is independent, and the third is moderating variable. Okay, first is dependent variable. What is dependent variable? Dependent variable is variable that is not independent and influenced by the others variable. It's gonna be independent variable, and the dependent variable in the study is abnormal return. So I'm gonna use abnormal return for the dependent variable. And we can see what is abnormal returns by defining conceptual definition of the abnormal return. Okay, abnormal return is defined as a change on the stock price caused by the factors other than the change that are common in the capital market. It's referred to Brigham and Alston 2019. So abnormal return is a change in stock market because on uncommon things in the stock market, and this change causes a difference between an actual return that uh, happens in the market with an expected return. So the difference between these are causes the abnormal return. Next. Okay, the next is the operational definition of abnormal return. This is explain how that we calculate the abnormal returns. Okay, the first is we're gonna calculate we're gonna know the actual return of stock in the day of T. It's the T day is an ex-dividend date, and we should deduct it with average return during the estimation period before the day. I'm using the T, um, the one day before the T date or ex dividend date till the 30 day before the ex dividend date. So I'm using that day for calculating the average return of security. Okay, as I have said that before, I'm using three variable, dependent, independent, and moderating. And now I want to tell about the independent variable. The independent variable is an independent variable where this variable will affect the dependent variable, according to Hardani et al. 2020. Okay, the independent variable is in the study is dividend policy, which calculated using dividend payout ratio or DPR as proxy. Okay, and then what is dividend policy and what is DPR? Okay, we can define it by known as a conceptual definition of dividend policy. What is dividend policy? Dividend policy is a decision related to the company's financial policy made by the manager and can be calculated using the DPR. What is DPR? DPR is a form of management commitment to share the result of the company's performance shareholder is regarding to Hadi 2020, and this is a percentage of dividends per share that distributed to the shareholder compared to the earning per share that generated by the company. That's the definition of dividend policy and DPR. Next, and the next is I want to talk about operational definition of dividend policy. In this study, the dividend policy is calculated by the DPR or dividend payout ratio, and this variable can be calculated by what is it, dividing the dividend per share by the earning per share. So DPR is dividend payout ratio, and DPS is dividend per share, and EPS is earning per share. The DPS is quarterly dividend can be calculated by interim dividends, and the dividend per share at the end of the year can be calculated by the final dividend year. And also for EPS, interim dividend can be calculated by the quarterly EPS, and final year dividend can be calculated by yearly EPS. And the third variable is a moderating variable. What is moderating variable? Moderating variable, as regarding to hardening at all 2020, is a variable that can strengthen or weaken the relationship between the independent variable and the dependent variable. And the study uses the earning information variable, which can be calculated by using earning per share as a moderating variable. Uh, next. Next, I want to talk about conceptual definition of earning information as a moderating variable. EPS is gonna be the proxy of earning information, so we use EPS for the calculating earning information. What is EPS? EPS is one of the most important information for the shareholder contained in financial report. It's regarding to Brigham and Hodgson 2019. EPS is a comparison between net income after tax to the number of shares issued by the company. That's an EPS. Maybe next. And now we're gonna talk about operational definition of information. Okay, as we said that before, we use EPS to calculate the dividend. So how to calculate EPS? EPS can be calculated by divide the EAT deducting by DP and divided by the number of share or SS. Okay, what is EAT? What is DP? EAT is net profit after tax for the current fiscal year for interim dividend, and the end of fiscal year for the final dividend. And what is DP? DP is amount of preferred stock dividend in the current year financial year for the interim dividends, and the end of fiscal year for final dividends. And what is SS? SS is number of share that outstanding that what is it? Outstanding share that owned by the companies at that year. And the next is data analysis technique. This study uses several data analysis technique performed with SPSS software. The technique used by the researcher or me is in this research is descriptive statistical analysis and classical assumption test, and then that consisting of normality test, multicollinearity test, and heteroscedasticity test, and autocorrelation test. And the study is also use t-test for the hypothesis testing, and f-test, and r-square test. Next. And the first is descriptive statistic analysis. What is descriptive statistic analysis? According to Sugiono 2040, descriptive statistic analysis is a statistical method that can be used in conducting an analysis of the data by describing and describe the data that has been collected as it is, without the intention of making generalized conclusion. And the descriptive statistics provide information about characteristics of the main research variables and the list of respondents' demographics. And the description of the description that can be given so descriptive statistic or data can be seen from the average or mean, standard deviation, variance, maximum, minimum, sum, and others. In this slide, we're gonna talk about the classic assumption test that consider with normality tests, multicollinearity tests, heteroscedasticity tests, and autocorrelation tests. Okay. First, we're going to talk about normality test. Normality test was conducted by researchers to determine whether the regression model between the dependent variable and independent variable was normal or not. In this case, the researcher uses the Kolmogorov-Smirnov for the normality test, and then the second is multicollinearity test. The multicollinearity test was carried out by the researchers with the aim of knowing whether regression had a correlation between the variables and or not, but dependent and independent variables. I'm using fifth for this uh, multicollinearity test, and then heteroscedasticity test. This this test to determine whether there was an inequality between the variance of the residual from the observation. And then the autocollinearity test. I'm using this test to see whether in a linear regression model there is a correlation between nuisance error in the use of period t and the error at the t minus 1 the day before. I'm using Durbin Watson for this test. Maybe next. And the last is moderated regression analysis, or MRA. What is MRA? MRA is a special application of linear multiple regression in which the regression equation contains an interaction element. So we're gonna find the moderated effect from this variable. The MRA test in the study was used to see effect of dividend policy on abnormal returns with earning information as a moderating variable. So we're gonna find is the earning earning information moderated the effect of abnormal return on effect of dividend policy on abnormal return. Okay, we're gonna use this formula uh, that in this slide. Okay, next. And the next test is hypothesis testing. I'm using the F test and T test and R square test. Okay, maybe we talk about F test. F test is used to test the feasibility of a regression model or fit test, and this is the criteria to know the F test is uh, have have a correlation or not. Okay, if the calculated f probability value is less than 0.05, it said it's a feasible, and if f test more than 0.05, it said it's not feasible. So yeah, it's the use of f test. After f test, we're gonna use r square test, which uh, R-square test is used to describe how a model's ability to explain variation that occur in a dependent variable. And what is the criteria of R-square test? Okay, the value of correlation coefficient or R-square range from 0 to 1. It's gonna be, or is it gonna be good for the R-square test. And then we're gonna do a statistical t-test. What is t-test? T-test is used to see whether or not there is a partial effect between independent variable and dependent variable. And the t-test can be done by looking at the value of the t-significance of each variable contained in the output of the regression analysis, with the decision making criteria is significance value more sorry the significance value that the t-test have an effect is less than 0.05. It can be said that the independent variable partially has a significant effect on the dependent variable. Okay, in this chapter I want to tell you about the results and explanation about this research. Okay, the third criteria is the companies distribute dividend expressed in rupiahs, and there is 22 companies that distribute dividend in rupiahs currency, and one company is that doesn't giving dividend in rupiahs. There is other that giving some dividend in USD currency, and the fourth is the company recorded positive profits during the 2016 to 2020, and then there are all of the company at this sample have positive profits during 2060 to 2020. And in this research, the data that used in this research conducting some industrial classification, and there is 14% companies that use in this research comes from energy sector, and then 9% from industrial sector, and 23% on financial sector, and then 18% on consumer goods, and then 9% in some chemical industry, and then 18% in infrastructure, and then 4% in some health industrial, and then uh, and 4% in non-primary consumer goods. And then besides a final dividend, we have it to interim dividend at quarter two, and interim dividend at quarter three. There is 78% that companies given a final dividend, and then 18% company giving the dividend when it was at quarter three, and then 4% in quarter two. Okay, there is a table about descriptive statistic before outlier. Okay, before outlier, the abnormal return mean it's gonna be minus 1.23%, and then the median of abnormal return is gonna be minus 1.22%, and then the maximum score of abnormal returns in this research is gonna be 13.83%, and then the minimum score from the abnormal returns is minus 10.10%, and then the observation of this data, it's 140, and for DPR, or dividend payout ratio, the mean of DPR is 39.55%, and then the median is 31.22%, and the maximum score of DPR is 176.68%, and then the minimum score of DPR is 1.65%, and then for the EPS, the mean is 533.7, and then the median is 348.5 rupiahs, and then the maximum is 3,033 rupiahs, and then the minimum numbers is 20 rupiahs. And this table is what is it? Explain about descriptive statistic after outlier. Okay, for the abnormal return, the mean number is minus 1.45%, and the median is minus 1.46%, and the maximum number is 4.78%, and then the minimum number is minus 8.04%, and then for the DPR, the score of the mean is 38.54%, and then the median of the DPR is 30.78%, and then the maximum number of DPR is 138.55%, and the minimum number is 1.65%, and for the EPS, the mean of the EPS is 548.07 rupiahs, and then the median is 350 57.0, and then the maximum number of EPS is 333 rupees, and the minimum number is also same as before outlier. It's gonna be 20 rupees. Okay, for knowing the best model that we can use in this research, we should do some testing. Okay, there is some test to be used for knowing what is the best model between fixed effect model and then common effect model. Okay, we know that we can see it from the cross section t-square that have a probability less than 5%. There is indicated that fixed effect model is better than common effect model. So if fixed effect model better than common effect model, we should do some test again. It's gonna be Hausman test that we will tell it in the next slide. Next. In this slide, we're gonna tell about Hausman test that to choose the best model between fixed effect model and random effect model, and if the probability of cross-section random is less than 5%, it's indicate that fixed effect model is the best model from random effect model. But in this research, the probability numbers of cross-section random it's 0.8928, that more than 5%, that indicates that random effect model is the better than fixed effect model. So because the random effect model is better than fixed effect model, we should do some testing again. It's gonna be Lagrange multiplier test. So in the next slide, we're gonna tell about Lagrange multiplier test to know that the best model between random effects and then common effects model. Okay, because of the random effect model is better than fixed effect model, we should do some Lagrange multiplier test to know that what is the best model between the random effect models than common effect model. So we can see it from probability of Bruce-Pagan. Okay, the probability of Bruce-Pagan in this research is 0.00486. That indicates it less than 5%. So if the probability of Bruce-Pagan less than 5%, random effect model is better than common effect model. So before outlier, the best the best model that we can use in this research is gonna be random effect model. Uh, and then at the slide before, we talk about model testing before outlier. So with 140 observation, now we're gonna tell about model testing after outlier that we can use 133 observation that used in this research. Okay, the first is chow test. Same as before, chow test is model testing that used to be to test what is better between fixed effect model and then common effect model. Okay, in this research, the probability of cross-section chi-square after outlier is going to be 0.0005. That indicates less than 5%. It indicates that fixed effect model is better than common effect model. So after the Chow test, because the fixed effect model is better than common effect model, we should do Hausman test like before. Maybe we can tell it in the next slide. Next. Okay, the Hausman test after outlier. Okay, same as before. If the probability of cross-section random more than 5%, it indicates that random effect model is better than fixed effect model. Okay, in this test, cross-section random of data in this research indicate that have a number of 0.3852, that more than 5%. So in this Hausman test, tell us that random effect model is better than fixed effect model. So because of random effect model is better than fixed effect model, we should do one more test, that is Lagrange multiplier, to know what is the better model between random effect and then common effect. Maybe we can tell it in the next slide. Next. Okay, there is a result of recurrence multiplier test after outlier that have a probability of Bruce-Pagan number 0.0165 that it less than 5%, that indicates our random effect model is better than common effect model. So the model that we use in this research is gonna be random effect models. Okay, as I have said that before, from the result of model testing, uh, after and before outlier, they choose a random effect model as the best model that we can use in this research. So this research gonna be use random effect model as a regression model for the EViews. After what is it? After model testing, we should do some tests again. It's gonna be called classical assumption test. Okay, the first what is it? The first step of classical assumption test, I'm doing normality test for this research to know that is it the data that used in this research normal or not. Okay, at first I'm doing some testing about normality testing with 140 data, and it showed that my data is not normal because of the probability of GB is indicate it's have a number less than 5%. That is 0.00000 and 0. So I should do something that makes my data is going to normal. So I'm doing some outlier or erase a data that have a lot of difference with another data. And the outlier data can be seen in this slide that I'm erasing some data from SNGR when they gave a dividend at 2016, and PTPP when it gave a dividend at year 2020, and PTBA at 2019, and then KLBF at 2018, and then KLBF2 at 2017, and then INTP at 2019, and ACRA at 2016. And from this result, I'm erasing 7 data. So so the residual data gonna be 133 data at this research. And then the normality after outlier in this research is have a probability of 0.1268819, that more than 5%. So it indicates that the data of this research is normal, and with 133 observation. And then yeah, we have a normal data. I have a normal data for now. And then the next is we're gonna talk about a multicollinearity test about this data. Maybe next. The heteroscedasticity test, the result if the ops error square is less than 5%, it indicates that the data have heteroscedasticity what is it issues. And then if the Glassjar test more than 5%, it's free from heteroscedasticity. So in this research, the ops R square numbers is 3.5734. It's more than 5%. So this data in this research is free from heteroscedasticity issues. The last assumption classic testing in this research is going to be autocorrelation test. Okay. Uh, if DU less than DW and then DW less than forming DU. So it can be concluded that there is no autocorrelation in this model of research. But and then in this research, the DU is 1.7474, which is less than the DW, that is 1.790729, and which is it's less than for mean DU, there is 1.2526, and then it can be concluded that the model of regression in this research is free from autocorrelation issues. And next, maybe we will gonna talk about moderated regression analysis. And in this slide, we will gonna talk about moderated regression analysis. And the first is the constant of minus 0.002782, means that when DPR and EPS have a value of 0, then the abnormal return on the company listed in the ALKI 45 index will have a value of minus 0.002782. And the second is the DPR coefficient of minus 0.030565, means that when the TPR decreased by 1 unit while the moderating variable, which is its EPS, is 0, the abnormal return on the company listed in the LQ45 index will increase by 0.030565. Okay, the next is fit and proper test that can be used by can be tested by F and R square test. Okay, when the F test is less than 5%, it's gonna be called the model of this research gonna be proper. Okay, the F of this research is 0.009187, which is it's less than 5%, so it can be concluded that the model of this research is proper to use. Okay, the last test is hypothesis testing or t-test. Okay, this test using a random effect model because of from model testing, the random effect model is the best model can be used in this research. Okay, the probability of DPR is 0.0022, that less than 5%, and can be concluded that DPR have a significant negative effects on abnormal return. So the first hypothesis that said that DPR have an effect in abnormal return is accepted, but the DPR, the EPS that can be moderated for the effect of DPR to abnormal return have a probability of 0.5816, that more than 5%, so can be concluded that the hypothesis 2 that said EPS has a moderating effect on abnormal return is can be rejected. Okay. In this research, can be concluded that dividend policy have a significant negative effect of to abnormal return. So the first hypothesis of this research is accepted, but why dividend policy have a negative effect? Because of a lot of investor thinks about if some company giving some dividends too high, it can be a signal for investor that the management cannot or don't have any plans to do some expansion. So the growth of the company is stopped when the company give all of the return earnings to the investor as a dividend. And the second hypothesis in this research is rejected. So the earning information is not moderating the effect of dividend policy to abnormal return. Why? Because of there is some transitory things in earning information that can be used for investor as an information for making a decision. So more investor believes in cash flow than earning information. So it cannot be used for investor to what is it to make a decision when some companies giving a dividend. So it cannot be strengthen or weaken the effect of dividend policy to abnormal return when some companies uh, what is it announce the dividends policy. Next. Okay, and the next slide we're going to talk about conclusion and recommendation of this research. Maybe next. The conclusion of this research is the result of testing. The first hypothesis is that dividend policy has an influence of abnormal return is accepted. The first hypothesis is accepted, and the second is the earning information moderate the effect of dividend policy on abnormal return is rejected. So uh, earning information cannot moderate, cannot what is it strengthen, cannot weaken the effect of dividend policy of on abnormal return. So the second hypothesis is rejected. Okay, the last is the implication of this research. Okay, the first is theoretical implication. What is the theoretical implication of this research? Okay, this research is hopefully can bring information about how the market reacted to the dividend policy that given by the company. So it can be a signal to investor about the dividend policy. It can be mirroring in the stock price, and then the practical implication first is for the company. Hopefully, this research can be used by the company to what is it to make a dividend policy to maximizing the investor what is it the to maximizing the value of the company, and for the investor this research can be used for maximizing the profit that can be what is it gain when some investor uh, buying some stock in the dividend period. Maybe next. Okay, but also this research can be have a limitation. The first limitation of this research is the variable used in the study were only limited to 45 companies that listed in LK45 index, and the time period used is only 5 years. That is from 2016 to 2020, and the study uses only one method of calculating the expected return, which is it's just only using the average abnormal return model. And the fourth is the study only uses stock price on the exited period. Okay, from the limitation, so what should the next research do to do some better research? Okay, the first is the next research hopefully can use another index between besides LK45 index, and then the second is the calculating or the formula of abnormal return can be calculated with different models, and then the third is using different stock price debt besides X debt, like income debt or debt or when declaration debt. Maybe that's all. Next. I think that's all for me. Thank you for the attention. Assalamualaikum warahmatullahi wabarakatuh.